David R. Guttery is the Chief Executive Officer of InSource Financial Advisors of Lincoln, Nebraska. David Guttery and Seth Edgil are financial advisors who represent Emeritus Investment Company, LLC, and Emeritus Advisory Services. Please stay tuned through the end of the video for additional important disclosure information.
Hello everyone, I'm joined today by Seth Edgil of InSource Financial Advisors for a conversation about what he calls the retirement red zone. Seth, that sounds serious. So what exactly is the retirement red zone and why should people pay attention to it?
Thank you for having me. The retirement red zone is a term often used to describe the 5 years before and the 5 years after someone retires. It is one of the most critical periods in a person's financial life. Why? Because this is when you transition from accumulating wealth to distributing it. For decades, you are adding money into retirement accounts. In the red zone, you're preparing to live off those assets. Research from Morningstar and other investment research firms shows that early retirement losses can have a disproportionate impact on long-term portfolio sustainability. This is often referred to as sequence of returns risk. The order in which returns occur matters more than the average return itself. This is why the red zone requires careful planning.
Well, you mentioned sequence of returns risk. That sounds technical. So can you explain that in simpler terms?
Absolutely. Let's say two retirees both earn an average return of 6% over 20 years. On paper, that sounds identical. But if retiree A experiences strong returns early in retirement and weaker returns later, their portfolio may hold up well. If retiree B experiences significant market losses in the first 2 or 3 years of retirement while simultaneously withdrawing income, their portfolio may struggle to recover. According to data compiled by Vanguard and JP Morgan Asset Management, early losses combined with withdrawals can significantly increase the probability of portfolio depletion. When you are contributing to an account, downturns can actually be helpful because you are buying at lower prices. When you are withdrawing, downturns can lock in losses. That is why the 5 years before and after retirement deserve extra attention.
So if someone is within 5 years of retirement, should they just move everything to cash?
Not necessarily. Moving entirely to cash introduces another risk, inflation risk. According to the Bureau of Labor Statistics, inflation in the United States has averaged roughly 3% historically over long periods. That means purchasing power is gradually eroded over time. If someone retires at 65 and lives to 90, which is not uncommon today, that is a 25-year retirement. The Social Security Administration reports that a 65-year-old today has a significant probability of living into their 80s or 90s. If your portfolio does not grow at all over that time, inflation can quietly undermine your standard of living. The goal is not to eliminate risk entirely. The goal is to manage different types of risk thoughtfully.
What changes in mindset should someone adopt as they approach retirement?
One of the biggest shifts is moving from an accumulation mindset to an income mindset. When you are 40 years old, the focus is often on growth. How much can I accumulate? What is my projected account balance at retirement? As you approach retirement, the question changes to how do I convert this pool of assets into reliable income? That involves planning around withdrawal rates. The so-called 4% rule originated from research by William Bingham in the 1990s and was later expanded by Trinity University research. It is suggested that withdrawing roughly 4% of a diversified portfolio annually, adjusted for inflation, historically allowed portfolios to last about 30 years. However, that rule is a starting point, not a guarantee. Market valuations, interest rates, and personal longevity all matter. This is where personalized planning becomes important.
Well, you have talked in prior segments about diversification and asset allocation. So how does portfolio construction change in the retirement red zone?
Asset allocation becomes even more strategic. For someone nearing retirement, we often want to evaluate How much short-term income needs should be insulated from market volatility? Some planners use a bucket approach. For example, short-term bucket, 1 to 3 years of income needs in more stable investments. The intermediate bucket, moderate risk assets. The long-term bucket, growth-oriented assets for inflation protection. Other planners prefer to a total return approach, where the portfolio remains diversified but withdrawals are taken systematically. There is not one universally correct method. What matters is understanding how volatility affects withdrawals and aligning the strategy with the client's comfort level and income needs. We also review rebalancing. After a strong equity year, portfolios can drift towards higher risk than originally intended. Rebalancing helps realign risk exposure.
Well, let's talk about Social Security. How does that factor into this red zone planning?
Social Security is one of the most important retirement income sources for many Americans. According to the Social Security Administration, for many retirees, Social Security represents a significant percentage of total retirement income. Delaying benefits increases the benefit amount by approximately 8% per year between full retirement age and age 70. For some households, strategically delaying the higher earner's benefit can increase lifetime survivor income. However, claiming decisions are permanent. Once you elect benefits beyond certain limited windows, you cannot easily undo that choice. That is why we model different claiming strategies within planning software before making a decision.
Well, you mentioned income tools earlier. So briefly, how do annuities or other protected income tools fit into this discussion?
For some individuals, introducing a portion of guaranteed income can reduce overall portfolio pressure. Certain annuities can provide predictable lifetime income streams. This can allow the remaining portfolio assets to remain invested with a longer-term growth perspective. It's important to evaluate costs, liquidity restraints, and suitability carefully. These are not one-size-fits-all solutions. They're tools. The objective is to create durable income that can withstand market cycles and longevity.
What about Roth conversions? We hear a lot about those.
Roth conversions can be a strategic consideration in the red zone, particularly in lower income years before required minimum distributions begin. Under current law, the required minimum distributions generally begin at age 73 for many retirees. Converting a portion of traditional IRA assets to Roth in early years may reduce future required distributions and create tax diversification. However, I want to be very clear here. I do not provide tax advice. Anyone considering a Roth conversion should consult with a qualified tax professional to evaluate their specific situation, tax brackets, and long-term implications. Tax planning must be coordinated carefully.
Well, you mentioned tax diversification. Why does that matter in retirement?
Because not all retirement dollars are taxed the same way. Traditional 401k and IRA withdrawals are generally taxable as ordinary income. Roth IRA withdrawals, if qualified, are generally tax-free. Brokerage accounts may receive capital gains treatment. Having flexibility across different types of accounts can allow retirees to manage taxable income more efficiently year to year. Again, this is not tax advice. It is about understanding how different account structures interact and planning accordingly with the appropriate professionals.
What are some common mistakes you see people make in the retirement red zone?
There are a few that stand out. First, underestimating healthcare costs. Fidelity has published estimates suggesting that the average retired couple may need hundreds of thousands of dollars over retirement to cover healthcare expenses, excluding long-term care. Second, ignoring withdrawal sequencing. Pulling from the wrong account at the wrong time can create unnecessary tax drag or accelerate portfolio stress. Third, failing to adjust risk exposure. A portfolio designed for a 35-year-old may not be appropriate for someone about to retire. And finally, making emotional decisions during volatility. If someone retires into a downturn and panics, that can permanently impair long-term results. Planning reduces the likelihood of emotional reactions.
Well, this sounds like a lot to manage. So for someone feeling overwhelmed, where should they start?
I would start with clarity. What are your expected annual expenses in retirement? What income sources are guaranteed? How much variability can you tolerate? From there, build a written income plan. Model different market environments. Stress test the portfolio. The retirement red zone is not about predicting markets, it's about preparing for uncertainty. None of us control market returns, but we can control savings rates, diversification, withdrawal discipline, and risk management.
Any final thoughts for viewers approaching retirement?
Yes, the 5 years before and after retirement are not a time for autopilot. This is when thoughtful coordination between investments, Social Security, income tools, tax planning professionals, and risk management matters most. With proper planning, the red zone does not have to be a period of anxiety. It can be a period of clarity and confidence. The goal is not to eliminate risk entirely. It is to build a resilient strategy that allows you to retire with dignity and sustainability.
Well, Seth, thank you so much for this information. It has been extremely helpful. And for additional information, Seth may be reached through the means listed on the following screen. For InSource Financial Advisors, I'm Brannon Dawkins.
David Guttery and Seth Edgil independently offer securities and investment advisory services through Emeritus Investment Company, LLC, member FINRA, SIPC, and Emeritus Advisory Services. Information provided in today's segments is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed and should not be interpreted as tax or legal advice. Any performance stated is past performance and is not indicative of future results.